Soft Currency Economics by Warren Mosler. More on why lead accounting is unworkable. Inelasticity of the demand for loans. Financial intermediation has developed into a sophisticated and essential institution in the modern economy. Lending is a practical reality of economic growth, and the demand for loans is very inelastic in the very short run. Even as interest rates change, the volume of outstanding loans adjusts on the margin, gradually. Many loans have a fixed rate and are not affected by interest rate changes. In the long run, loan demand and thus reserve demand become somewhat more elastic as individuals and businesses respond to interest rate changes. Many commodities share the property of short-run inelasticity. That is, the demand for these goods does not change with a change in the price of the good. Consider, for example, a group of scuba divers' demand for air. If the divers were down to their last few breaths of air and were unable to surface, they would surely be willing to pay any price for a tank of air. The only options for the divers are buy more air or perish. The imaginary seller of air would be able to set any price for his air. The quantity of air, however, depends entirely on what the divers need. Once the divers have enough air, additional air is of no value. The buyers determine the quantity, and the seller sets the price. The inelasticity of the banking system's demand for reserves is somewhat analogous to the inelastic demand for a scuba diver's air. The Federal Reserve can set the price of reserves, but the quantity is determined by the banking system. The market for reserves is not perfectly inelastic because the Fed allows some spillover into the accounting of bank reserves from one period to the next. This practice allows banks to smooth out some of the volatility of their reserve positions, but it does not change the inelastic nature of the market for reserves. Efforts to force the market to accept fewer loans than are demanded would be nearly as disruptive as forcing the divers to make do with no air. The banking system would have to reduce their outstanding loans by forcing customers to immediately sell off assets financed through the banking system. The senseless dislocation of assets caused by forced disintermediation makes such an action unthinkable. Central bankers who understand the intractable nature of the banking system's loan portfolio recognize the necessity of lagged reserve accounting. A sensible approach to changing the money supply employs a change in the Fed funds rate to gradually bring about the desired result.